Hello, everyone. Thank you for joining us for the session today. I hope each and every one of you is safe and healthy during this pandemic. Today, we have with us our esteemed faculty, Anurag Agarwal. He's basically a digital transformation leader with around 20 plus years of experience, and he's currently the co-founder and director of Data Block Technologies, and we are going to basically hear from him about multiple use cases of blockchain technology in financial services. So without further ado, Mr. Anurag, thank you so much for coming and joining for the session. You can take it forward.
All right. Thank you, Vatsal. Thanks for the nice introduction, and good evening to everyone out here. And as Vatsal said, I hope that everyone is keeping safe and everyone is staying at home during these very challenging times. But it's all up to us that how do we best utilize this particular time. And I feel that MAT Future Academy has been doing a great work in organizing a couple of courses and programs what they have on new age technologies, which is proving very useful for all the participants, whether they are students or professionals, in basically upskilling themselves during these times when we cannot go out a lot. So basically, as Vatsal told, that I'm the co-founder and director of Data Block Technologies. It's a blockchain company, and we are based out of Noida, out here in which is near Delhi. So me and my colleague founded this particular organization around 4 years back. We had already worked in the IT industry in the professional field for around 18 to 19 years. And we saw so much potential in this particular technology that we both left our jobs and founded this organization around 4 years back. And it's basically a blockchain focused organizations. And we basically focus on one is blockchain consulting. Then we have been developing production solutions around blockchain. And then the third part is that we have been into training and capacity building a lot. Because as happens with any new age technology that people have heard about the name a lot, but there is not much understanding that how do all the systems work and all those kind of things. So there we feel that the training and education for any new, for any upcoming technology is pretty important. So we have been trying to focus on this area and share our knowledge and our experience. So without wasting further time, the way we would be going ahead with this particular webinar is that we would be first talking about the key elements of blockchain and the benefits of blockchain for the couple of minutes initially. And then we would jump onto the use cases of blockchain in financial services. Because financial services has been the industry which is amongst the first one to basically embrace any new technologies which comes into the market. So, and similar thing we have noticed with blockchain as well, that we have a couple of very powerful and useful cases where blockchain is transforming the way financial services industry works. But let's take a couple of minutes initially to first understand that what are the key elements of blockchain? How do the blockchain brings benefit to basically brings benefit to any industry, not just financial services. So moving ahead, right. So to start the discussion, it has been said just to emphasize the potential of this particular technology. It has been said that blockchain has been the biggest invention after internet and electricity. And what World Economic Forum is saying that around 10% of the global GDP would be on blockchain by the year 2025. And this is what we have been noticing as well, that basically all the big organizations in the world have been investing heavily in blockchain technology because of the benefits they foresee. But still the technology is in its infancy. You need to understand that where internet was in the year maybe in the early 1990s, that is where blockchain is currently. So we don't know, and the people don't really appreciate the potential of this particular technology and how it is going to change the way all the processes and all the businesses might change like as the time goes ahead. And I have also noted down a couple of the quotes from the major magazines, whether it might be Forbes or Wall Street Journal, what they have been saying about blockchain, and basically and the potential which they feel that this particular technology holds. Going ahead, let's touch upon the key elements of blockchain. Since you people are attending these particular use case sessions, I'm pretty sure that you might be having a certain background about what blockchain is all about, what are the key features of this particular technology. But just to rewind the things, let's spend a couple of minutes to understand what these particular technology is all about. See, blockchain has 4 key elements, what I have listed down out here. First of all, it is a decentralized and a distributed ledger, right? So, first of all, let us understand what a ledger is. See, a ledger is a file which is usually a computer file that records data and transactions made by a user. And in simple words, the distributed ledger is a ledger that is distributed across everyone in the network. So like we don't have a centralized ledger. Suppose you have a bank passbook. That is a kind of a ledger. But all the data related to that particular transactions, what you make with the bank, it is stored centrally in the banking systems. But here, in the case of a blockchain, all that information is shared across all the nodes in a blockchain. And what is a node? A node can be anything. It can be your laptop, it can be your tablet, it can be your mobile phone, anything. So basically any particular device which is a part of that particular blockchain network becomes a node. So like a distributed ledger, and like since it is a distributed and a decentralized ledger, like a distributed ledger is basically a database that is shared, replicated, and synchronized among the peers of the network, right? It is a peer-to-peer transaction, whatever happens in blockchain. And the main feature of the distributed ledger is that it is decentralized. Decentralization, here it serves as the primary advantage to the users. Because when a ledger is updated, each node in the network, it constructs the transaction and then come to an agreement that the copy of the ledger is correct. And only once it is agreed by all the nodes in the network, once it is agreed by all the nodes in the network, then only the nodes update themselves with a new copy of the ledger. So all the nodes present in the network, first of all, need to give their consent that a particular transaction can be added to the ledger. Then only that particular transaction would get added onto the ledger, right? So basically every record in the distributed ledger also has a timestamp and it has a unique signature. And basically that unique signature comes by the cryptographic technique, which we are going to touch upon, and which makes this particular ledger immutable and basically safe from tampering. Now, another key feature of this particular blockchain is consensus. What is consensus? Like every transaction made using a blockchain, it has to be it is verified and it is extremely secure. The reason for its security is the presence of this consensus algorithm. According to the definition, a consensus algorithm, it is a process in computer science, and it is used to achieve an agreement on some information among the distributed systems. Now, the consensus algorithm was designed for the blockchain technology to achieve reliability in a blockchain network having multiple nodes out here. And hence this ensures that every incoming block in the network is entirely validated and secure. Then only once the consensus is reached, then only any block which has the information inside it, then only it gets added onto the blockchain. Now, there are several kinds of consensus algorithms, but the two most popular ones are proof of work and secondly the proof of stake. What is proof of work? Very briefly, see, the proof of work algorithm, it is a functional tool that is used to process the blocks in a blockchain, and it is used to add them onto the blockchain network. To add a block into the blockchain network, first of all, we need to show that the block is correct, right? So therefore, the process of generating correct proofs, which are blocks, to add a block to the blockchain, it is known as something like, in the parlance of blockchain, we called it, we call it blockchain. We call it blockchain mining. And the ones basically the nodes who do the mining, they are called as miners. Therefore, to add a block to a blockchain, the miners first have to solve a cryptographic puzzle, and only then a block is added to the blockchain. So once the blocks, they solve a cryptographic puzzle, whichever particular node solves that particular cryptographic puzzle, they just sort of raise a hand, and then they say that the cryptographic puzzle has been solved. Then the block is added onto the blockchain network, and then the entire network moves to solve the next cryptographic puzzle, so that the next block can be added to the network, right? And the other consensus mechanism which we usually use in blockchain frameworks is proof of stake. See, in proof of stake algorithm, it is a little different from the proof of work algorithm. As in, it follows a different method to generate block within a blockchain. Like we discussed in the proof of work algorithm, the miners who successfully crack the puzzle, they are allowed to create the blocks. So how do things happen in this proof of stake consensus? So here we have something called validators. The validators, they are chosen by specific criteria set by the proof of stake system. Usually the criteria, they are the economic stake of the validator in the network. So whichever node has a greater stake in the blockchain network, they have a higher say in deciding that what information goes into the blockchain network. So if a validator, say for example, they possess a lot of coins, then the validator is then basically that particular validator is chosen to generate the blocks. So therefore, the probability of a validator being chosen, it depends on the number of coins they possess in this particular case. Another criteria to get selected is referred to as coinage. Here what happens is that since how long the validator is holding those particular coins, that becomes important. Longer the period, higher is the probability of getting selected as a validator, right? So these are the two methods by which we do the consensus. Now moving on to the cryptography. Cryptography is the practice of developing protocols that prevent third parties from viewing private data. It is basically a mathematical, it is basically a mathematical field which is used in blockchain cryptography. And it uses public key cryptography, hashing, all these kind of things. And this public key cryptography, it is a fundamental element of a blockchain technology. It is the underlying technology for wallets and transactions. So when a user creates a wallet on a blockchain, they are generating public-private key pairs. And the address of that particular wallet or how it's represented on the blockchain, it is a string of numbers and letters generated from the public key. Now, due to the nature of blockchain technology, this address is public to everyone, and it can be used to check the balance in that particular wallet or coins to it. So the address is it in the public domain, but who owns that particular address is not known to anyone, right? So the private key is used to access that particular wallet, and basically it is used to prove the ownership and control the wallet. It is the only way to send coins out of it. And a lost private key, this is pretty important, guys. And a lost private key, it means that the coins inside will be stuck there forever. So that is the importance of this particular private key, whoever has the wallet on that particular blockchain network. Now, here in the same way, we have something called cryptographic hashing. This is another fundamental piece of blockchain technology, and it is used to directly responsible for producing immutability. What is immutability? It is something which cannot be changed. So this particular immutability, it is one of the most important features of blockchain technology. And hashing, so as I was just discussing about hashing Hashing is a computer science term that means that taking an input string of any length and producing a fixed length output, right? So it doesn't matter if the input to a certain hash function, it is 3 or 100 characters, the output will always be of the same length, right? You can think of this particular hashing function as as kind of a black box, right? Something goes into it and the output is always of a fixed length. And how do the hashing function work? That is a very detailed mathematical subject altogether, which you don't need to worry about it. But you just need to know that whatever the size of the input, the output would always be of the same size. And secondly, it is not possible to find the input by just looking at the output. These are the two fundamental things what blockchain technology uses. Another very important part of blockchain technology, which you might have already heard, is smart contracts, right? So smart contract, to be honest, it's just nothing it's just nothing but a piece of code. If we use Ethereum blockchain, we program smart contracts in Solidity language. So distributed ledger technology, it enables the coding of smart contracts that will execute when certain specified conditions are met. So smart contracts, it might help you exchange money, property, shares, or anything of value in a transparent, conflict-free way while avoiding the services of a middleman or an intermediary. Like I would just give you an example. Suppose if you go to take a house on rent, right? So in that particular case, you would need to sign some kind of a lease agreement with a person that who is giving their house on rent to you. And in this particular case, both the parties need to use the services of an intermediary, which is generally a property broker. And the property broker comes into the picture because both the parties, they don't trust each other, right? That is the reason we have a property broker in between. And then we sign an agreement that on the first of every month, maybe 20,000 rupees would be given by the tenant to the house owner. But if this particular thing is encoded as part of a smart contract and put on a blockchain, then that particular blockchain would automatically get triggered. That particular smart contract would automatically get triggered on the first of every month, and 20,000 rupees or the equivalent bitcoins would be transferred from wallet A to wallet B. So in this particular case, we would have a peer-to-peer transaction and there won't be any need for any intermediaries. Now, briefly touching upon the benefits of blockchain. As this particular slide shows, we have 4 major benefits of blockchain technology. And because of these particular benefits of blockchain technology of transparency, security, efficiency, trust, and traceability, which brings in, this particular technology has come up very fast in the last 3 to 4 years, right? First, upon touching this particular benefit of transparency. See, transparency is one of the big issues in the current industry. To improve the transparency, organizations have tried to implement more rules and regulations. But there is one thing that doesn't make any system 100% transparent, and that is centralization, because all the data is stored in a centralized place. But with the help of blockchain, an organization can go for complete decentralized network where there is no need for a centralized authority. And this improves the transparency of the system. Secondly, enhanced security, which blockchain brings in. Blockchain, it utilizes advanced security compared to other platforms or record-keeping systems. Any transactions that are ever recorded needs to be agreed upon according to the consensus methods which we talked about previously. And also each transaction, it has to be encrypted and has a proper link to the previous transaction using a hashing method, right? So security is also enhanced by the fact that each node holds a copy of the transaction ever performed on the network. So as I was telling, that each node would have a copy of the particular ledger stored with themselves. That is the reason we don't have a centralized information, or we don't have a centralized ledger. Every particular node has a copy of their own transaction. So like if any malicious actor ever wanted to make the changes in the transaction, he won't be able to do so, as other nodes will reject his request to write transactions to the network, because every particular node has their own copy of the transaction, right? Coming to the efficiency part of it. Another benefit which blockchain basically brings in is the improved efficiency and speed. Blockchain, it solves the time consuming process and automates them to maximum efficiency. And it also eradicates human based errors with the help of automation out here. Because the digital ledger makes everything possible by providing a single place to store all the transactions. And here the streamlining and the automation processes also mean that everything becomes highly efficient and fast, right? Now, and the last point out here, the benefits of blockchain is the trust and traceability which it brings in. Because every transaction whichever happens on the blockchain, it is recorded on the blockchain forever. And you cannot change any particular transaction on the blockchain. That particular feature brings in the traceability part of it. You can only append the information on a blockchain. You cannot change any information on the blockchain. And every particular transaction which goes on the blockchain, it goes, with the particular address, that which particular address on the blockchain made that particular change, along with the timestamp. So that brings in the trust and traceability. Because this particular traceability part is very important in the supply chain. That works with the vendors and suppliers a lot. Because in the traditional supply chain, it is hard to trace items that can lead to multiple problems, including theft, counterfeit, and maybe sometimes the loss of goods. But with blockchain, what happens is that supply chain becomes more transparent than ever. It enables every party to trace the goods and ensure that it is not being replaced or misused using the supply chain process, right? Because in the current supply chain process, right from the time it is produced and to the point that it lands with the customer, basically the customer would be able to view the entire supply chain. They would be able to view all the hands through which it passed using the blockchain network and make sure that it is not a malicious product, right? So these are some of the things which I thought of covering before we actually jump onto the major use cases of blockchain and financial services industry. Now, see, blockchain has use cases across industries. It might be healthcare, banking and financial services, manufacturing and supply chain, or maybe government and public sector, etc. We have significant use cases of blockchain across all verticals, across all industries. But as part of this particular use case session, we will concentrate on some significant use cases in financial services industry, and which are the big banks and which are the big financial institutions which have been using blockchain as part of their businesses already. So as part of those particular things have moved, I have seen that things have moved from just the proof of concept, and they are being used as part of enterprises, these blockchain platforms. So the first blockchain use case which we are going to talk about is KYC and AML. See, you might have all heard about KYC, which is know your customer, right? So whenever you go to open a bank account or maybe go for applying of a housing loan, etc., banks ask you for all kind of documents, which might be your Aadhaar card, your address proof, your PAN card. And this is done to prove your identity, so that banks and all financial institutions, they know that they are dealing with the right and genuine customers. Okay. And while doing KYC, businesses take into account the end goal so as to know the identity of the customers before or during the instant they initiate the businesses with them, because it's very important for them. And banks and organizations of varying sizes are significant supporters of this particular KYC. And KYC policies, they have been extending for quite a while. And they have become very crucial all around, along with issues relating to corruption, terrorist financing, and illegal tax avoidance, these kind of things. And things like KYC and AML, they basically came into effect after a September 11th terrorist attack in USA. After that, we had a host of regulations in United States, like in banking sector, we had some kind of legislations like the Patriot Act, Bank Secrecy Act. And after that in India, the Reserve Bank of India, like the rest of the world, they also followed the lead and rolled out the speculated Know Your Customer in a full-fledged manner in 2004. And this was followed by Securities and Exchange Board of India, which is SEBI, and they rolled out similar measures in 2012, basically. And now, what is AML, which is anti-money laundering law? See, the global impact of money laundering is staggering nowadays. With the related transactions, they are estimated to be anywhere between 2 to 5% of our global GDP, which roughly translate to $2 trillion. Which is huge amount of money. So, a scam is everywhere. It might be your banking, it might be your payment industry or businesses. So therefore, there's an utmost need to bring out such a system which is fluent and which could mitigate the risks associated with the processes. So for preventing all these illegal transactions, specific laws and regulations are prescribed. They are mandated to make the transactions safe and secure, and hereupon the anti-money laundering law, which is AML, which comes into picture. Now, coming to the major challenges which current KYC systems, the current KYC processes they have. First of all, one of the major challenges what current KYC processes they have is that there's a lot of disparity in specifications, because every bank has their own specifications they adhere to, and each bank asks for some different set of documents. And moreover, when you go to any bank or financial institution, you have to submit all the documents all over again. So due to this lack of standardization, complying to each request in a customized way is it is a very time consuming process. Another challenge which this particular process has is that we have very stringent regulations, and the regulations by the central bank, they changed very often. So adding more compliance burden on the banks. So whenever central banks, they change the regulations, all the banks have to follow all those particular regulations, adding to more compliance burden on them. So what all information is to be collected by the banks from the customer, it basically changes over a period of time. They have to again reject their processes. Now, all these things, they lead to adverse impact on customer relationships, obviously, because it becomes irritating for a customer to provide the same set of information to different banking entities, sometimes in the same jurisdiction, itself. And banks may even have more follow-ups periodically for KYC. Suppose if I go to today I go to a bank to open a bank account, I would need to submit some set of documents. And maybe after 6 months, if I go to take a housing loan, I would need to submit again the same set of documents which I have already submitted to the bank. So these things happen because the information is not centralized. So, because the information is centralized and it is not being shared between different banks and different financial institutions. So because of which there is an adverse impact on customer relationships, because the customers feels they have to submit the same set of information and same set of information again and again to different entities. And all these all this results in escalating costs. I was reading somewhere a report from Thomson Reuters, and they estimated that due to the hassle of this KYC, onboarding costs for banks, they have increased by 18%. And they foretell that there would be a further increase of 14%. So you can see that a lot of money is going into these administrative costs, which can be easily, reduced if the processes can be much more simplified. And apart from the escalating costs, it also takes a lot of time. Onboarding time for a new customer is now around, say, 4 to 5 days, because the banks have to manually check all your documents. So this slide basically shows you that how does the current KYC process work, and if we start using blockchain and put the KYC process in a blockchain, how it might simplify the things. Now, coming to first, how does the current KYC process work, right? So currently, how does the process work? It is shown in the diagram out here, but just to give you people a very summarized form of the information, here what happens is that first you go to the bank to say open your bank account. The bank tells you that what all documents are needed for the KYC process to be done. If you are smart enough, you carry all the documents at one go. But most of the time it happens that you miscarry some of the documents. And then you need to make a second visit to the bank, right? Some bank executive then manually checks all your documents and then sends all these documents to a centralized intermediary, which might be the central bank. Now, this centralized intermediary stores your data in a central database. Here, data security becomes a major issue because all this is your personal data. And because it's a centralized database, there are chances of hacking and substantial costs are incurred to keep the data of millions of people safe and secure. And other financial institutions can request the central intermediary for your data, but that seldom happens. And you are supposed to submit all your documents all over again if you go to a different bank or a different financial institutions. So this is the way we all know that the current KYC process is working currently. Now, if we bring this particular process on a blockchain, as we know that the blockchain and as we have discussed, that a blockchain is an immutable distributed ledger. So every participant interacts with the blockchain using a public-private cryptographic key combination, which we talked about in cryptography techniques. So in its essence, since blockchain is devoid of any single central authority, banks are taking keen interest in its applications to solve the hassles which are created by the present use of the KYC process. For the KYC operations, banks can either use a private or a public blockchain. If we have a private one, then bank uses it for its internal audit or regulatory compliance. But if they are using a public blockchain, it shares data and control with other institutions as well. So how does the process work? Basically, what happens is that whenever a new customer enters into the ecosystem, then a trusted party, that is to say the bank, verifies their documents. Second step, once the documents are checked for veracity, then the bank uploads this data onto the blockchain. And whenever new data is needed to be appended, you simply need to append the ledger. You don't need to depend on the bank to do that. And these updates in the information can be accessed by other entities in real time. as and when required, because all the data is now present on a blockchain. And so we have something of a digital identity, which is which is analogous to a digital passport of the onboarded customers, which can be used as a trust sign for all future transactions, right? And since it is a decentralized and a distributed database, there is no single point of failure and your data is secure. So this is the way the KYC process can be streamlined using a blockchain system. Coming to the benefits of blockchain technology for KYC and AML processes. The first one is data quality. See, data alterations can be tracked and monitored, so chances of misuse and fraud are reduced. Since traceability is one of the key benefits we talked about of using a blockchain. So here we are able to track and monitor all the alterations which are being done. And since data is stored in a homogeneous blockchain, it results in better governance as well. And use of data would help detect fraud at an earlier stage. Then we have a lower turnaround time. It happens because direct access to the KYC data, which is stored on a blockchain, could save huge amount of time for banks and other financial institutions. And the hassle of disparity in specifications can thus be eliminated, which results in lower turnaround time. Another benefit is a secure way to store individual information. So if blockchain is utilized for KYC and AML compliance, a client could make a single block by feeding his or her data. Consequently, this information would then be put into a code and saved on the blockchain. So the person is provided with a password or a private key, which must be input, taking into account who the customer wants to look at their data. So basically we are giving the entire authority to the customer, and they decide that their data can be viewed and used by which entity on the blockchain. It's not that their personal data is lying unsafe on the blockchain. Since they have a password or a private key, they have the authorization to decide that which particular entity gets to view their data. Now, another benefit is that same blockchain registry can be used by various banks and financial institutions, which we were talking about, right? Because now there wouldn't be any need to share the same set of information again and again with different banks and financial institutions. Coming to this anti-money laundering. See, an anti-money laundering system based on blockchain can utilize the cryptographically secure, decentralized, and immutable nature of this particular technology to identify and stop suspicious transactions immediately and effectively. A distributed blockchain-based system using smart contracts, it would allow financial institutions to securely parse the data through an anti-money laundering engine on the blockchain itself. So in case of fraudulent transactions, alerts can then be issued to stakeholders and the transactions can automatically be flagged and they can be stopped maybe for further investigation. So some of the work, as I told, is already being done in this space. Like IBM has already partnered with HSBC Bank and Deutsche Bank, and it is a part of their shared corporate Know Your Customer platform. So basically, whatever information goes onto the blockchain, it is being shared by HSBC and Deutsche Banks, and there won't be any need to again go through this process again and again. Similarly, Cognizant, it has it has partnered with Indian insurers to join hands for blockchain customer data sharing. This is to assist the insurers to collect customer and policy informations for various KYC related due diligence activities. So basically, in conclusion, to sum it all up, these aspects, it may be inferred that by the intrusion of blockchain in KYC ML procedures, banks can assure more prominent security, more consistency, and it would bring in more operational efficiencies, effectiveness in it, because they are able to save the time, they are able to do the things much more faster. It brings more transparency into the entire system out here. Now, another use case which we are going to touch upon is cross-border payments, which is very important, and it is this cross-border payments, it is being absolutely being transformed by using blockchain technology. See, cross-border payments might involve big companies which are involved in export-import kind of business, as well as some kind of remittances which are done by individuals. Like you might know that, just to take an example, that there are millions of people from India who are settled in Gulf countries who need to send money back home to India, right? So, I mean, what do? They use some kind of intermediary, like Western Union money transfer or some sort of agency like this, right? And these agencies, they charge a very hefty commission in between, sometimes which might go up to 15 to 20%. And moreover, it takes time, sometimes up to a week, for their folks to receive the money in India. So we are not only losing money, I mean, we are not only losing our money by using these intermediaries, but we are also losing precious time, right? So, what are the current challenges in this cross-border payments, which are being currently faced? First of all, sending an international payment through established banking channels, it is a very complex and a multi-step process, as you might imagine, and this involves several intermediaries. Like suppose if a company A in the United States wants to pay company B in India, then company A asks its US bank to send a payment overseas. Now, the US bank partners with a correspondent bank to facilitate the transfer. And a respondent bank out here in India receives the funds and then transfers it, and basically it then transfers it to company's B bank account. So each step of this particular process requires time and money to complete, creating an overpriced and a frustrating kind of a bottleneck. And then all the players which come into the picture out here, they take their own commissions. So blockchain solves these particular challenges by streamlining the process and storing every transaction in a secure distributed ledger. So as soon as a transaction is recorded, the receiving party has access to that particular payment. There would be no middleman, no delays, no unnecessary fees. And once a payment is entered, it can't be reversed, because that is one of the main features of blockchain. Or it cannot be changed on a ledger. And this would foster greater overall accountability and also bring in more security. Another challenge which cross-border payments process they have is high fees. This we have already discussed just now, that since the processes involve so many intermediaries which come into play, everyone charges their own commission, and the money received by the recipient is significantly less than what was transferred at the beginning. Now it is a slow payment processing. In this process, payment can be stopped at any point, maybe due to incomplete payment information in this long and complicated payment path. So this results in both delays and sometimes an unsatisfied kind of a customer experience as well for both the parties involved in this particular payment transfer process. Now, this also results in personal data privacy regulations. See, various regulations on what information or cannot. See, because you might appreciate that this particular cross-border payments, it involves different countries. So basically it involves different jurisdictions. So various regulations on what information can or cannot be shared only further complicates this particular cross-border payment process. So banks, they need to closely follow these regulations, and they need to invest a lot of their time trying to organize that what information can be transferred across different jurisdictions, because every country would have their own laws and regulations. So bank needs to follow the laws and regulations of the particular jurisdiction of the country in which they need to operate. Now, this particular slide again shows the traditional process of traditional process of cross-border payments. And then secondly, it shows that what would be the new process if we bring blockchain into the picture. In this particular process is handled using blockchain. So first, let's see what is the current method of cross-border payments. Here what happens is that the person or organization which wants to do money transfer first contacts or go to their bank where they have an account. Now, the process is initiated at this step by the bank. They enter all the details in their payment system, like what is the amount to be transferred, what are the bank details in which the money needs to be transferred in the foreign country, and basically does the pay account has the requisite balance in their bank accounts or not. All these validations first needs to be done. In some cases, it might always happen that the pay's bank from which a transfer needs to happen and the bank in which amount would need to be credited, they do not have direct interface with each other to validate all the information. So in this scenario, some correspondent banks come into the picture. It might happen that a person sitting in the United States maybe who has their bank account in say Bank of America. Now they need to make some cross-border transaction to some kind of a cooperative bank in India, which are really small. So in this case, there might not be any direct interface between these two banks. So some correspondent banks would come into the picture on both sides to basically facilitate this particular cross-border payment. So here, institutions, they are required to reach a consensus in routing the payments, performing currency conversions, and deploying and managing liquidity in different jurisdictions. And all these particular different jurisdictions would have their own regulatory constraints which banks would need to follow. And remember, more the number of intermediaries, greater would be the cost, because each stakeholder would now take their commission for providing their services. And also there would be a longer time before the transaction would be closed, right? And I was telling, this process is complex. It is very time consuming, as well as high fees goes into it. Now, how can things happen on a blockchain? Blockchain, as we have discussed, it is a universal ledger in a distributed network, which is accessible to everybody in the network. Thus, each node in the network will have a complete copy of the entire database or the ledger, and any modifications to the same will have to be duly verified by other nodes or other parties which are present on that particular network to make sure whenever the modification is done. So this would mean that direct transfers can occur instantly now, and without fear of any manipulation by all these intermediaries, which were coming into picture initially, for the cross-border payments, because now there are no intermediaries or correspondent banks which are involved. So here we have a peer-to-peer transaction, right? So the underlying concept of this distributed ledger in the blockchain makes it possible for the banks to have a bilateral, visible, and immutable transfer of value, instead of all these particular intermediaries coming into the picture out here. Coming to the benefits this would bring in to the industry of cross-border payments. See, cross-border payments supported by blockchain provide significant advantages to businesses and customers. Blockchain-based payments are cost-effective, almost immediate, secure, and transparent. I was reading a Deloitte report which estimates that business-to-business and person-to-person payments with blockchain result in a 40% to 80% reduction in current transaction costs, and it basically takes an average of 4 to 6 seconds just to finalize the transaction as compared to 3 or 4 days using the standard transfer process. So basically it becomes more cost effective because instead of paying transfer fees to multiple parties, companies using blockchain only need to pay a single nominal fee or nothing at all. Cost savings will be substantial for organizations in this particular case. That makes, for those companies, that makes frequent international transactions. Another benefit it would bring in that it would be almost immediate. Blockchain payments are completed in close to real time, right? In seconds rather than days. So the ability to transfer money instantaneously helps businesses be more agile and responsive, taking action on new projects or addressing customer needs without waiting for funds to come through. It would also bring in the transparency because blockchain eliminates the risk of discrepancies in record keeping. We have a decentralized ledger out here, which would hold a verifiable and irreversible record of every transaction and distributes it for all the users on the blockchain. It would bring in the security. Now, when records are kept by one central authority like a bank, they are vulnerable to interference. So if that authority is hacked or damaged or taken offline, then users could have their data compromised. With blockchain, all the transactions are secured by cryptography, right? And then they are tied to a previous transaction and distributed among participants in a ledger. So to tamper with data, a hacker would have to alter all earlier transaction in the ledger, which is practically next to impossible. And central banks of Canada and Singapore, like the way we have Reserve Bank of India out here, similarly, central banks of Canada and Singapore, they have already concluded a trial of cross-border payments using this particular blockchain technology, and they have been very successful in it. I mean, it has to really gather pace, but once you have some kind of a proof before you, then it hardly takes any time before before that particular technology is accepted worldwide, and in this particular case, other central banks start using it, right? Another very important use case for financial services, which we are going to cover, is in the insurance sector. So first look at the major pain points which insurance industry faces, and then we would jump as to how blockchain can be used in addressing those particular pain points. The first and one of the major challenges which insurance industry faces, as you would also imagine, is the lack of trust between the insurance companies and the customers. That is one of the major pain points in this particular industry. This is the reason why many individuals, they don't bother with insurance. Many insurance firms, they fail to pay claims, and they don't own up to offering some benefits. Therefore, most people just see insurance as one of those unnecessary expenses. Secondly, this insurance industry is very fraud prone as well, as you might imagine. Just to take an example of India only, insurance companies in India face an abnormally large number of fraud cases. In fact, it is estimated that Indian insurance industry, it loses close to $6 billion in $6 billion to insurance frauds, which which comes around to around 8.5% of all the premiums collected every year. However, a fake claim on life insurance policy, it is 6 times more likely as compared to other types of policy. So, how do insurance frauds happen? Just to giving you an example, the most common way to defraud a company is to have insurance policy issued to a person who has a terminal illness. This does not happen much in urban India, but however, there is not much infrastructure as you might imagine available in rural India, right? So buying insurance in the name of a ill person is not that difficult in those particular areas. Because the doctor who comes to check the patient for any pre-existing illness, they are they are either bribed or they can be threatened. So even if a person suppose has say cancer, the doctor will write a report that says that they are fit to provide insurance. Later, when the person dies of cancer, the insurance money is fraudulently collected by the family. And insurance companies in India also provide riders wherein if a person dies of an accidental death, then the payout is double of the sum assured. So this provision is also misused in order to make some fraudulent claims. So if a person having an insurance policy dies even of natural causes, then dependents might claim that the victim died because of an accident. And once again, maybe the doctors or medical maybe medical professionals, they are forced to obtain some relevant document, which leads to massive losses for these insurance companies. Another challenge which insurance companies faces is that they have very limited underwriting accuracy. So there is something called underwriting in insurance. Most of all you might be aware of it, but for those who don't know about this process in insurance business, I would just briefly explain it. See, underwriting is the process through which an individual or institutions they take on financial risk for a fee. With insurance underwriting, the focus is on potential policyholders. The person seeking health or a health insurance or a life insurance. In the past, the medical underwriting for health insurance was used to determine how much to charge an applicant based on their health, and even whether to offer coverage at all, often based on the applicant's pre-existing conditions. And in life insurance, underwriting seeks to assess the risk of insuring a potential policyholder based on their age, health, lifestyle, occupation. Basically, these are the things they decide that how much premium a person is supposed to pay for their health and life insurance. So like in this case of life insurance underwriting, it can result in approval along with a whole range of coverage amounts, prices, exclusions, and conditions, or it might even occur outright rejection, that the insurance company would say that they are not prepared to give you an insurance. So this accuracy by which all these things are properly judged by the underwriting, by the underwriters, is a big challenge for insurance companies. Another big challenge in the insurance industry has to do with fragmented data sources or inefficient exchange of information, as you might see in this particular slide. And this data silos it prevents the companies from having a holistic view of their customers. Experts, they have highlighted insurance companies' inability to easily share and access data across their organizations as one of the major pain points in the industry. And the insurance industry faces foundational challenges as it attempts to aggregate a wealth of customer data. So if you see, there are three general functions organizations perform with data as part of the data lifecycle. First is gathering data, then storing data, and finally delivering the data. One of the biggest challenges in this lifecycle is reconciling data from multiple sources from across an organization. One reason for this is that the legacy systems have led to data silos within the companies itself. So different departments aren't communicating with each other. So companies, they don't have a complete picture of their customers. So this is one of the major challenges which they face, and they spend a lot of money in gathering and basically having a holistic view of their entire customers. So we have seen the challenges which insurance companies face currently. So now let's focus on two major areas where blockchain can help in streamlining the processes and in turn help insurance companies perform better. First of all, we would touch upon claims processing. Let me go to that slide. So first of all, we would touch on claims processing, that how can blockchain help in claims processing. See, blockchain technology can fundamentally alter claims submission process to reduce fraud. We have seen a number of ways the frauds happen in insurance industry. So basically, blockchain can reduce those particular frauds and improve the customer experience. Putting policies on a blockchain as smart contracts, what we talked about, it would radically improve the efficiency, saving insurers more than $200 billion in operating costs, according to a survey done by BCG, that's a Boston Consulting Group. So, let's use the car insurance to illustrate for an example. So if you get into a car accident and it was the other driver's fault, then you must submit a claim to your insurance company to recover your losses, right? Now your insurance company investigates your claim and tries to recover money from the other driver's insurance company. And then the other insurance company has its own claims processes, which leads to duplicated work, delays, and possible human errors as well. So the end result is that you get paid money much later than you would like. And insurers themselves, they spend a lot of time and money on unprofitable kind of activities. So putting insurance policies and claims data on blockchain, that different insurers and different reinsurers or maybe brokers and other parties can access, it reduces the duplicate manual work being done by different parties in this particular case. So insurance companies as smart contracts on a blockchain automatically execute programmed claims processing actions, automating the information transfers between different insurers and parties and releasing payments to policy holders. Because this is what we talked about smart contracts, that some pre-existing conditions are built into it, and whenever those particular conditions are met, then certain actions get triggered automatically. And additional info such as claims forms and supporting documents, supporting evidence supplied by the policy holders, they can always be later added to the blockchain so that all parties have the same information, and making disputes very rare in this particular case, because it would be very transparent. It would be accessible to both the insurance companies. It would be accessible to both the parties. Another major use case of blockchain in insurance industry is reinsurance. So what is reinsurance? See, reinsurance is an insurance that an insurance company purchases from other insurance company to insulate itself from the risk of a major claims event. Now, with reinsurance, the company passes on some part of its own insurance liabilities to other insurance company. And the company that purchases reinsurance pays a premium to the reinsurance company, who in exchange would pay a share of the claim incurred by the purchasing company. And in this case, a reinsurer can be either a specialist reinsurance company, like there is a major reinsurance company, Swiss Re, or which would undertake reinsurance business, or it can be other insurance company itself. So within reinsurance, blockchain technology can help reduce costs. It would improve risk assessment, and it would enhance the client onboarding. So how does this entire reinsurance work today? See, the current reinsurance process is extremely complex, and it is, I tell you, it is notoriously inefficient. With reinsurance, each risk in a contract needs to be individually underwritten, and contracts typically take up to 3 months of wrangling between different parties before they are signed. And what happens is that insurers will typically engage with multiple reinsurers, which means that data has to be exchanged between different parties to process the claims. Different data standards between institutions, they also often lead to different interpretations of how a contract should be implemented. So how does reinsurance using blockchain technology might help? See, blockchain technology has the potential to append current reinsurance processes by streamlining the flow of information between insurers and reinsurers on a shared ledger. Using blockchain technology, different transactions around premiums and losses can exist on an insurer's and the reinsurance computer systems at the same time. And this would eliminate the need to reconcile books between institutions for each and every individual claim. So with data on an immutable ledger on a blockchain, reinsurers can be better equipped to allocate capital for claims nearly in real time, allowing them to process and settle claims more quickly without relying on primary insurers for data around each claim. And I was reading a PricewaterhouseCoopers estimates that the blockchain can deliver reinsurance industry-wide savings of up to $10 billion by increasing these operational efficiencies, what we talked about. And this would trickle down and lead to lower insurance premium for customers as well, because it's estimated that reinsurers accounts for 5 to 10% of existing insurance premiums which are paid by the customers. So if we streamline the process, it's going to help the customers basically by trickling down the benefits to that level itself. Now, coming to our last use case of blockchain in the finance industry is in trade finance. See, trade finance is currently a $8 trillion market, and it is it is a $8 trillion market, which is roughly around 10% of the world's GDP. And trade finance, it represents financial institutions and products that are used by companies to facilitate international trade and commerce. So trade finance, it makes it possible and easier for importers and exporters to transact business. To explain to you what is trade finance. See, while a seller or an exporter in this case can require the purchaser, who is an importer, to prepay for the goods shipped, the importer may also wish to reduce their risk by requiring the seller to document the goods that have been shipped. Here, currently, banks assist by providing various forms of support. For example, the importer's bank may provide some kind of a letter of credit to the exporter or the exporter's bank, providing for payment upon presentation of certain documents. So it is some form of a guarantee from the side of the importer's bank that complete payment would be done by the importer upon receiving the goods. Now, there are two things which you need to know here. First is the letter of credit. What is a letter of credit? It is an undertaking or promise given by the bank or financial institute on behalf of the importer to the exporter that if the exporter presents the complying documents as specified in the purchasing agreement, then the buyer's bank or financial institute will make the complete payment to the exporter. That is the letter of credit. You might have heard about this term in the Nirav Modi bank fraud case with the Punjab National Bank, where fraudulently some letters of credit were issued. Then we have something called a bank guarantee. See, it is a kind of a guarantee from a lending organization. The bank guarantee signifies a lending institution ensures that the liabilities of a debtor is going to be met. So in other words, if a debtor is unsuccessful to settle a debt, then the bank will cover it. A bank guarantees that allows the customer to acquire goods, purchase equipment, or draw down loan. In simple terms, basically a bank guarantee is a promise from a bank or some other lending institution that if a particular borrower defaults on a loan, then the bank will cover that particular loss. That is the bank guarantee which the importer's bank gives to the exporter's bank. Now, let us see of some of the current challenges in trade financing industry. First of all, we have the manual contract creation. Here, the import bank manually reviews the financial agreement provided by the importer, and it sends financials to the correspondent bank. Now, points 2 and 3 have to do with the intermediaries, which leads to delayed payments and delay in shipment of goods, since every activity needs to be done manually. And we all know that blockchain is something which does away with intermediaries and manual intervention, because of which it has led to most promising use cases in trade financing. Now, another challenge is that multiple versions of truth exist. Since multiple entities are involved, then we would have version control challenges which would always exist. Multiple platforms are also a challenge. Since it's mostly a cross-border transaction, we have multiple forms of IT systems in use built on different platforms, which makes the chances of fraud very high. Now, how can blockchain act as a solution here? See, blockchain can reduce the processing time. It might eliminate the use of paper and save money while ensuring transparency, security, and trust. Like, these are the key benefits of blockchain and trade finance. Removing the bad actors, forcing everyone to pay pay fair in a new transparent way of doing business will virtually it would virtually eliminate the risk of manipulation by the participants in this entire chain. And the arrival of end-to-end trade finance network for banks and their corporate clients is facilitating trade finance directly between the parties and increasing efficiency in the market. By making it easier to exchange trade-related data and delivering finance to the entire ecosystem, such trade finance network, it has the potential to prove itself as a game changer rather than just another initiative. And like over a dozen of the world's foremost financial institutions, they are active in trade finance, including BNP Paribas, ING, Royal Bank of Scotland. They are already stepping up their attempts to shift trade finance onto blockchain technology. So basically, these benefits they highlight how many bankers see trade finance as an area with the most significant potential to benefit from blockchain technology. Because we have a highly inefficient, fragmented, and some would say a broken infrastructure and customer delivery experience it is a rather ripe use case for disruption using blockchain. And these solutions, they are being built on blockchain. Now, coming to the key benefits which blockchain technology would bring in using trade finance is that a better coordinated and a higher automated and a far more open infrastructure will enable more efficient trade finance solutions for customer in this new goal for businesses. However, this can only be achieved through the creation of a trusted permissioned interactions between corporations and B2B network, service providers and other financial institutions. Now, the major benefits is, of course, first one is the smart contracts. See, most of the benefits are listed out here, but I would just like to highlight the most important ones. So, smart contracts is one of the major ones out here. See, because the introduction of these smart contract, it allows the businesses to automatically trigger commercial actions based on defined criteria. Once again, this will also further boost efficiency by streamlining the processes, removing time and cost of doing transactions. Auditability is another very key benefit because an audit trail also proves, it also provides improved traceability, which is one of the major benefits of blockchain in trade finance. The new verification levels automatically check assets for authenticity. So as a result, what happens is that businesses can reduce both fraud and compliance costs by ensuring that each transaction is recorded sequentially and indefinitely. Another major benefit is security. See, from a security perspective, blockchain allows simple, secured, share trade-related data between different financial institutions. Each transaction is verified within the network using independently verified complex cryptography. So by adding some much needed commercial transparency, in conclusion, so by adding some much needed commercial transparency to this mix, old problems such as delays and sharing data between parties, it is replaced by unprecedented levels of trust, which is really needed in trade financing. So because of this blockchain technology, words such as authenticity, transparency, simplicity, they are rapidly becoming the new language in the trade finance market. So these are the major use cases of course, if you go to internet, you would be able to find other major use cases of blockchain in financial services industry. Because what I have seen in my experience is that financial services industry is always the first mover in embracing any new technology which comes. And I have seen that this has also happened in the case of blockchain technology. All the banks and financial institutions have been the major movers in adopting this particular technology. So yeah, this is what I had for today. Uh, uh, these are some of the references which I used for putting these particular slides together. So yeah, this is what I had. Uh, uh, Vatsal, are you there? So I have completed the things from my end. If there is any query from anyone, I would be happy to take it.
Sure. We have two questions, and first of all, I would like to thank you, to share your detailed perspective and detailed insights on each of these use cases. I think people are attending in mass numbers. We'll just take two questions, and we can
Sure.
wrap this session up. So, first question is from a fresher. He basically says that, so can anyone learn blockchain technology? As I'm a commerce student, and I am coming from a non-technical background, but I'm very interested in blockchain.
Okay, that's a good question. See, blockchain is not a computer science technology. Blockchain is a combination of mathematics, economics, and computer science. So you don't need to be a coder, or you don't need to be a developer or coming from a technical background to understand this particular technology. And here is where, like the course which is offered by MIT Future Academy, it is a very exhaustive course. It doesn't just cover only the technical aspects of blockchain, but it covers the blockchain in a very holistic manner, bringing in the entire bringing in the entire concepts in a very cohesive manner. So to answer the specific query, you can always take this particular blockchain technology and learn the blockchain technology. I mean, you don't need to be a technical geek to really learn about these particular concepts.
Okay, another question.
Yeah, but
I think
what was the second
another
one?
question is from Shrikant. He says, where can we contact to
Hi,
obtain
Shrikant.
blockchain transactions? I
Sorry,
think
where can you?
where can we
Yeah, if you can.
contact? Yeah, if you can probably explain what exactly is the question. Shrikant, if you can elaborate. I think we have another question that came up just now.
Sure.
This is from Sahu. He says, without coding, can we make career in blockchain? In the market, I've heard that blockchain having few projects going on. I think this is exactly what you answered.
Yeah, right. I mean, blockchain industry. I mean, people working in blockchain, they are very hard to come by. As I have seen in my organization, it's very difficult to find the right people in this particular area because it's such a new technology. And basically, the jobs which are involved out here, they are simply not of blockchain developers. We need blockchain analysts, which are pretty important. We need people who understand economics. So, you can take this particular blockchain. It's not that you need to work only as a developer only.
All right. So Shrikant basically says that he wanted to understand if there's any regulator for blockchain in India currently.
No, currently we don't have a regulator. I mean, since this is a very new technology, there is no umbrella organization currently which is acting as a regulator. There is no umbrella organization around the world, or specifically in India or in United States, or for that matter in any country, which is acting as a regulator. The whole system is working on its own. The whole system is so robust. Just to take an example of Bitcoin blockchain, Bitcoin is also a blockchain, right? Just to take an example of Bitcoin blockchain, it has been running 24/7, 365 days a year for the last 10 years, and it hasn't been hacked yet, right? So basically, it's the system which takes care of all these particular things. There's no regulator as such.
Got it. I think, yeah, we are done with the questions. In case anyone has any further questions,
Anyone has
anything,
anything else? Yes, please.
Yes.
I would like to suggest out here is that the course offered by MIT Future Academy on blockchain technology, it's very exhaustive. I have personally known people who have taken up this particular course, and what I have found is that those people, they have been like, they have the right concepts, and they have been able to scale up very fast once they land up in the industry. So I have known people who have done this particular course, and I mean, those are the people who really understand this particular blockchain, and they have been very useful across the industry.
Thank you for your kind words, sir, for our program. And yes, our program is especially for working professionals,
Yes,
and it is a
yes,
very industry relevant and
I know that.
rigorous
I have seen the
academic.
content. Yes, yes, yeah, yeah,
Uh,
and
so
yes,
anyone who wants to get more information can surely reach us out, on our website, or our email ID, which is there. And yeah, so with this, sir, I would like to conclude the session. Thank you once again for taking out time and sharing your insights and
yeah,
use cases. It was a
sure,
pleasure to have you in this session,
yeah,
and thank you
yeah.
everyone for coming and joining us.
Yeah. Thank you for having me, and I would again like to thank all the participants for joining in and basically spending their time. I hope it's useful, and maybe you take this as a career profession going forward. Thank you.
Thank you, sir. Thank you all.